Hello, everyone. Welcome back and Happy New Year. And I am excited to present to you the first video of the new year of 2026 with a very exciting, set of undervalued opportunities that I am currently seeing. I'm very, very excited and enthusiastic about this. And so let's get started. These are my 8 top picks for 2026. So let's dive right into them. So before we begin with which companies I have that I'm very optimistic for this year, uh, I just wanted to present the general framework that I'm using before even making these selections. So the value investing framework, and this is the guiding principle behind the Zacks Deep Value portfolio. That is another one of our model portfolios that I directly manage here at Zacks. And it is based on three principles that we need to see converge together. So we want to target that center, that middle point there in which companies that have all three aspects of value. And you want to make sure that you're blending not just low PE, but rather focusing on multiple compression. That's the key difference here. Instead of looking at companies that trade at 10, at a PE of 10 or 8 or 9, we want to see multiple compression. That's the bigger emphasis that I like to place, where a company that was once trading at a 40 PE that, compresses down to a 25, that starts to get interesting. And I use a little bit of math to come up with a estimate or a calculation as to how the severity of that multiple compression. Is it one standard deviation lower than its long-term average? Is it possibly even two standard deviations below the long-term average, a 10 to 20-year average? So I like to look for those types of opportunity sets, looking for companies that are enduring a very deep multiple compression. But then after that, step number two is we want to do some qualitative work. Does the company have an economic moat? Are they doing something that is hard to replicate? Or does it have high switching costs? Or does it have high barriers to entry? Is there something that's protecting the company from competition? So that's very important. You want to have, both multiple compression and some reassurance that the company isn't being generally disrupted. And a big part of economic moats is the presence of high ROIC. So you want to see companies that generate consistently high returns on invested capital. When that happens, and again, if you've been following me on my channel, on all of my past videos, you'll know that ROIC is a major part of the investment model that I deploy here at Zacks and the various model portfolios that I manage. Companies that demonstrate consistently high ROIC tend to have the best returns over time because, in general, if you have a high ROIC and if you can sustain it for multiple years, that means that you're doing something that's not easily replicated by others, which means that there is an economic moat that you're sitting on. So I love to look for companies that have, that type of a setup. And then, of course, you want growth opportunities, which is the last part of it. There are companies that have high ROIC but negative growth. That's possible too. The most important or the biggest example of that comes to mind is tobacco. Tobacco companies have exceptional ROIC. They also have a moat to a certain degree. It's not very often that you see companies entering the tobacco space, at least not in this century. So there are companies, all the companies that operate within the tobacco industry, they all have remarkable ROIC, uh, but they don't have a lot of growth ahead. In fact, they have negative growth in many cases. So this is the trifecta that I look for when picking value stocks or value opportunities. So again, economic moat, that helps increase our conviction, right? Deep multiple compression is often due to short or medium term difficulty that the company is facing. This may complicate earnings and ROIC during this time, but it still greatly increases the margin of safety, right? Because there are greatly lowered expectations that's implied in the stock's valuation. So that gives us a lower bar for us to beat. And if there is a reasonable expectation of a stabilizing growth outlook, well, then you've got a trifecta here. So this is again in a table format that I just wanted to present to you. This is the trifecta that you really want to find to be able to separate value traps from true value opportunities. So that's exactly what we like to look for. When all three align, the stock experiences significant appreciation as returns are compounded by both earnings growth as well as PE multiple expansion. Remember, that is the dual engine of stock returns. When you have, companies that are priced for contraction, but you end up getting a company that is now being priced for growth, you get not only earnings growth, but you also get an associated PE expansion that comes with it. So you'd go from a company, you'd go from, a 10 multiple on very depressed earnings expectations to a 20 multiple on much more bullish earnings growth expectations. So that together compounds the returns that you can realize if we can get and dial in on these three principles together. Um, so, when this happens, even boring companies, right? There are companies out there, like if you recall about a year and a half ago, I did a video on 3M. 3M is, I would say a boring company, if you will, a boring company that's just doing 3 to 5%, earnings growth and 1 to 2% sales growth. That's basically what 3M was. But if you can get these three aligned here, right? The economic moat, deep multiple compression, and a stabilizing growth outlook based on some, basic research that you perform. If you get all three that align properly, then even boring companies can deliver huge alpha. And if you recall, I was very bullish on 3M, and over the course of the next 15 months, the stock essentially doubled. And it doubled on just 5% earnings growth and about 2% sales growth. So that's the reason why this approach can be very, very powerful to achieve, excess returns. So it does require a lot of patience, though, often waiting 1 to 2 years for stocks to put in a major cyclical bottom as the headwinds that the company's facing come to an end. But, for that reason, value investing is tricky because we don't want to rush in to buy the dip when the headwinds are expected to continue for an extended period of time. So, that being said, you want to see all three align and, enter it with some patience, enter it, when you see the stock stabilizing rather than going straight down. You don't want to buy a falling knife, as they say. But you do want to find companies that have these three aspects and some evidence of stock price stabilization before entering. So without further ado, let's take a look at the companies I like for 2026. And this is a typo. I wrote six here, but it's actually eight. Eight undervalued opportunities I see in the market right now. And here they are. Celanese, Strategy, also known as MicroStrategy beforehand, Novo Nordisk, Enphase, Adobe, Albemarle, Texas Pacific Land Corp, and Copart. So let's take a look at some of these here, or take a quick look at each of these companies. Novo Nordisk shares are down more than 50% after the company cut guidance repeatedly. But if you look at it here, earnings continue to compound. Remember, this is a company whose bread and butter is insulin. That's where the vast majority of their long-term growth comes from. And I don't see any evidence that diabetes is decreasing. If anything, it's going to continue to increase. And unfortunately, that is because until we see people change their diet and exercise habits, I don't think that diabetes is going away anytime soon. And so, for that reason, Novo Nordisk is riding a secular wave in the insulin market, that will last for decades to come. But they also have other drugs, on the market too. Um, but, you know, the stock did go through a massive drop, primarily due to intense competition from Lilly's Mounjaro. That triggered Novo to respond with deep price cuts, which eroded margins. So that really tanked the multiple on the stock, right? However, now look at the price point now at 13 times forward earnings. And that too, it's a 13 multiple on steeply reduced forward estimates that reflect the new reality. The pharma giant, I believe, trades at its lowest multiple in decades. I think that is a great bargain at this point, where you're now buying the company at the lowest valuation in more than 20 years. And that is despite the fact that the core earnings continues to expand, and they continue to enter new markets as well. They just launched a oral version of their weight loss drug that just hit the market in North America. I believe that this is a franchise that will continue to compound for years and years to come. And now you're getting to buy it at the lowest multiple in the company's history. And again, this is a company that is insulated from any macroeconomic uncertainty, as the premier provider of insulin based drugs, as well as other aspects that they're entering as well, in addition to the GLP-1 space, where they are a strong number two after Eli Lilly. So I think this is a phenomenal value opportunity that I think will yield terrific results over the next 1 to 2 years. Strategy is another thing. This is a company, it's a little bit more unorthodox, if you will. This is not a company that generates earnings per se, but the reason why I'm including this in this presentation is because this company was once trading at a stratospheric premium to its NAV. Remember, Strategy is a company that holds enormous amounts of Bitcoin. That's their main operation. They buy Bitcoin endlessly, but the company traded at a massive premium to the value of its Bitcoin. As you can see on the chart here, for most of 2024 and 2025, it was trading at a premium of 50 to 100% above its NAV. Even more at one point, it was actually trading at almost 3 times its NAV at one point in 2024. That's ridiculous because, this is a company that buys a liquid asset like Bitcoin. Anyone can buy Bitcoin, so why should you pay any premium at all for owning a asset that I can just go out and buy myself? So it didn't make any sense at all. But now, if you see here, that premium is entirely eliminated. It now trades at basically a 1-to-1 ratio versus its own underlying Bitcoin holdings. And that too on a conservative measure because this is looking at the MNAV, which is the enterprise value divided by the value of its Bitcoin holdings. So remember, enterprise value actually adds the debt that they take on. So it's market cap plus debt minus cash on the balance sheet divided by its Bitcoin NAV. Now, since that number is now trading at parity, at a 1-to-1 ratio, I think now is finally the time to buy, MSTR, where it's essentially a leveraged bet on Bitcoin. So if you're bullish on Bitcoin, which I am at least as of right now, then MSTR is a buy for 2026. Now that this irrational premium has been essentially evaporated, and it's now finally trading at a rational valuation relative to its own Bitcoin market value. So if you actually take a look at the market cap to Bitcoin, that's actually trading at a discount, which it should because it does have a lot of debt. So the enterprise value, which counts the debt, right, is now trading at par with its NAV. So I think that is finally, a reasonable valuation to start buying MSTR here. So that mispricing that existed for basically 2 years has now been eradicated entirely. As you can see that it was at a much more reasonable valuation throughout 2022 and even most of 2023, but then it got disconnected from reality for all of 2024 and most of 2020, in fact, all of 2025. until just now, late in 2025, early 2026, it's finally back to reality. So if you're bullish on Bitcoin, then MSTR is a buy at today's price. Celanese is the next one. This is a bet on a cyclical recovery of chemicals. I think these shares are very cheap. You can see it trades at basically a 10 multiple relative to depressed earnings expectations. This company basically trades at, a forward multiple of 10 most of the time. And now that we've seen a major cyclical downturn almost complete, I think it's getting ready for a recovery with chemicals on the upswing here. There was, for about 2 years, there was softness in demand coming from the automotive and construction industries, which really blunted their earnings. The company has already responded with $120 million in a cost savings program. This, I believe, has right-sized the company, and now it's ready for a cyclical recovery in the top line, with acetyl demand hitting a bottom in 2025. Remember, Celanese makes a number of industrial chemicals. They are a key supplier for battery manufacturers. If electric cars reaccelerate in 2026 through 2027, I think shares are very attractively priced, just 8 times 2026 earnings estimates here. So this is a very, very cheap stock. And I think, earnings are ready for a recovery as you can see here from analyst expectations. So this is a company that's trading on a low multiple to a low earnings expectation. So this will transition very quickly from low multiple on low earnings to a higher multiple on higher earnings. That's exactly what we look for here. And again, this is the company that is moated. There are only so many companies that operate in this space, and Celanese is a key competitor in this area for decades and decades, and it doesn't, that's not changing anytime soon. So I think these shares are very cheap, and it's getting ready for a major turnaround in 2026. Copart, the same thing. You can see again, as you can see, the common theme here is we're buying, companies that have endured significant multiple compression, and Copart is just another example of that. This is a durable long-term compounder. As you can see here, earnings generally go up over time. They are insulated from economic uncertainty, from economic downturns. They are a durable long-term compounder with a wide moat. This is actually uh, a duopoly industry. They operate in the used and salvage vehicle auctioneering industry. There's really only two companies, and Copart, basically is a essentially a 50 to 55% market share in that space. They have an entrenched moat due to long-term relationships with car insurers. They're also a real estate play with nearly 20,000 acres of land in every major metropolitan area across the US. Shares are down 40% from the recent highs. I think that's a buying opportunity because this is a long-term compounder. Earnings really only go up over time. Shares are down mainly because of margin pressures, because for the last 2 years or so, as the Fed raised rates, used car prices have really come down. But I think that has mostly played out here. As you can see, this is typically a buying opportunity. You can't see it on the chart, but whenever this stock gets to its 100-day moving average, that typically represents a great buying opportunity, and that's where we're at right now. So with this significant multiple compression, within the context of long-term compound growth of earnings, I think Copart is getting ready for a big, year in 2026. As you can see here, this is a company that consistently demonstrates high ROIC and strong reinvestment. This is the balance sheet of the equation. As the invested capital keeps going up, this is, basically when the company reinvests its earnings to buy more and more real estate to expand its network. And it continues to generate high returns for every dollar that it invests. That is the recipe for compound growth over time. So this is a compounder, in which shares are down 40%. I think that's a great and attractive buying opportunity. for, possible big return in 2026. Albemarle, this is a bet on lithium demand recovery. Lithium is in a secular bull market. You can see that these are the industry growth estimates out to 2030. Lithium is not only used in electric cars, but it's also used for battery storage. Battery storage is actually a major area of growth throughout the world, especially in China, but also in Europe and in North America. Tesla is a major market player for battery storage, energy storage systems, very large utility scale battery storage systems. And Albemarle is the number one US lithium miner, lithium extracting company, and lithium refiner. And I think shares are extremely cheap relative to the secular growth outlook over the next 5 years. So this is a low multiple combined with earnings acceleration over the next 5 years, which I think are only starting to get priced in now. I was actually bullish on this late last year, but unfortunately I never made a video about it. But I am going on the record now, as of January 2026, to recommend shares of Albemarle. But if you were a subscriber to the Zacks Deep Value portfolio, this was actually a part of the portfolio since April of 2025, when we launched that portfolio. So we got in at, the ground floor valuation here when shares were ultra cheap, basically at a generational low over the past 20 years. That has really corrected itself now, but as you can see, I still think that the stock is cheap and it has plenty more upside to go. It could reach a Shiller PE, which is the PE multiple relative to normalized earnings of about 30 times. So that could get another 50% increase in the multiple combined with increasing earnings growth expectations together. So remember, that's the dual engine of stock returns, increasing multiple on increasing earnings expectations. Um, so I still think that this is a stock that's very attractively priced. Texas Pacific Lands, this is a company that has historically been associated with the oil and gas industry, but it's now an unorthodox AI play at an attractive valuation. You can see the stock is down, almost 50% from its highs. But I still think that it is a long-term compounder. This is a company that owns over 880,000 acres of land, primarily in Texas, around the Permian Basin. They generate royalties from the oil and gas industry from pipelines that run through their properties. So they have recurring revenue. It's a highly attractive business model that they have. They literally own the land on which oil and gas pipelines run through. And so oil and gas pays Texas Pacific Land um, royalties on a fixed monthly basis as well as on a percentage basis, um, relative to realized revenue that they get. So there is some cyclicality to it because it does depend on the price of oil and natural gas, so as well as volume. So with prices taking a hit, sometimes Texas Pacific Lands also takes a hit on realized earnings. And because oil and natural gas prices are down so much, that's the reason why TPL has gone down so much. But now, beginning in late 2025, they've begun diversifying from energy into leasing property for the construction of data centers. So this will unlock additional revenue at very high margins because it requires very little capital outlays. They have already got the land. They already have pipelines running through their land that they're already getting paid for. Why not monetize the other land that pipelines aren't occupying to lease to data center companies, right? That's a genius idea. And so you can see that the stock is now starting to realize the potential for more revenue and earnings without any additional capital outlays, essentially, because they've already got the land. So now they could monetize those 880,000 acres with additional revenue coming in from data centers. And yet, shares are still down almost 50% from the highs. I think this is a great entry point for a company that is a long-term, high-quality compounder, um, that is now potentially going to monetize their land in an altogether new way, which would be very high margin, pure ROIC. That's very, very bullish, very, very exciting. So I would be a buyer of Texas Pacific land on any weakness, and I think it's going to have a breakout 2026. Enphase Energy, deep value opportunity for the best-in-class solar company. You can see this has been a deep dive from its highs. You can see the reason for that is because solar really got hit hard because of the fact that as the Fed raised rates, solar demand really took a nosedive because, this is a residential solar company at the end of the day, and individuals require financing for the most part when they buy their solar panels. But now that the rate hike cycle is largely complete and rates are now headed lower, I believe that in fact, all of the demand destruction that happened is now complete. It's fully priced in. Shares now trade at just about 11 or 12 times earnings, which is very cheap for a company that is still, I believe, in the midst of a secular bull market. I still think residential rooftop solar is still in a long-term uptrend, even though we took a sort of a detour these past 2 years because of the incredible rate hike cycle that we just went through to control the record high inflation. But now that that's largely complete, I think now the stock is ready to rocket higher over the next 5 years, but that might begin this year as demand returns, especially because electricity prices continue to soar. So the ROI on rooftop solar is getting better and better as the cost of electricity continues to rise as well, without any associated rise in the cost of installing rooftop solar on a per kilowatt hour basis. So this is the premier company, I believe, within residential rooftop solar, that I think is very, very cheaply priced and getting ready for a breakout year in 2026 and beyond. Adobe, yet another company priced for disruption. The big story here is that everybody's worried that generative AI is going to eat their lunch. You have, these companies like Midjourney and others that, you could just, enter a prompt and Midjourney just creates beautiful video based on, your couple of sentences that you've written that, might encroach on Adobe's Premiere software as well as Photoshop for generative AI image software, companies out there. So, the thesis is that this is going to push prices lower, which will pressure Adobe's margins, take away, significant demand for those products. That's been the narrative, and that's the reason why the stock is down so much and is trading now at the lowest multiples in about 20 years, really dating back well, maybe not 20 years, but at least 15 years, dating back to 2011. However, we have not seen any evidence that this has been the case. We just haven't seen it. And we just got earnings last month in December, and we continue to see earnings and revenue climb, and earnings and revenue both hit record highs in 2025 with 11% year-over-year growth, with continued subscriber growth within their Creative Cloud business. ARR continues to hit record highs, and ARR is actually the leading indicator because that's the portion of the revenue that is recurring in nature. That's the type of revenue that comes, as a subscription base. Um, and that number has just not gone down. So despite the fact that we're now in year two of generative AI gaining popularity, we still have not seen any impact um, on Adobe's revenue and ultimately on Adobe's earnings. You can see here that analysts continue to project continued growth well into late this decade. So if this is correct, if we see that generative AI just didn't do much or at all anything to Adobe's business, this is a generational buying opportunity for Adobe. So I believe that this is getting ready for a breakout year because the prevailing thesis for the past 2 years has been that AI is going to disrupt them. But if that doesn't happen, um, this is going to get repriced in a violent way. Remember, this is currently a very low multiple company, the lowest multiple in almost 15 years. If this gets repriced back to the historic multiple that it typically trades at, um, which is 20 to 25, this is easily a 600 plus dollar company within the next year to 2 years. And right now it's well below that. It's at 300 as of today's video. So I think that this is a very, very attractive risk reward setup. That's right now. So going back to the original slide that I did, the basic strategy here, um, deep multiple compression, which implies a pessimistic outlook. Is there a wide moat? And does the company have a durable revenue stream and or high likelihood that the headwinds that led to the extreme multiple compression in the first place are dissipating? If you answer yes to these three, then you can have very reasonable confidence that the dip that you're buying is going to lead to significant returns over the next year to 2 years. I just want to pull a quote from Charlie Munger. Over the long term, it's really hard for a stock to earn a much better return than the business which underlies it. So if you're buying a high ROIC companies, right? As long as you're buying high ROIC companies, um, you're most likely going to walk away with a substantial return on your investment. So especially if you're buying a high ROIC business that is on a deep discount, you're going to end up with a hell of a result. And because remember, what he said is if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with one hell of a result. Well, if you're paying an expensive looking price on a high ROIC business and still get a great result, imagine what happens if you pay a cheap looking price on a high ROIC business. And that's exactly what I think what we're doing here with these 8 companies here. So hopefully you found this helpful. I'd love to hear from you. Any feedback, any questions? Remember, a lot of these companies are in the Zacks Deep Value portfolio and many more like that. If you want access to this portfolio, if you have questions on the strategy, if you have any feedback, I'd love to hear from you. Please do reach out to us at 1-866-794-6065 or send us an email at info@zackspro.com. Or actually, sorry, the better email is strategycall@zackspro.com. So please do reach out to us with any questions, feedback, comments. I'd love to hear from you. Sounds good, everybody. And I will make a video revisiting this video, probably towards the end of the year to see how I did with each of these 8 picks. So let's see how we do here. But as of right now, I'm very bullish on these 8 companies, and good luck to everybody here. Again, this is just my opinion, not a professional investment advice, and this does not necessarily reflect the opinions of Zacks Investment Research. Please do perform your own due diligence, your own research before taking any of these investment ideas. And look forward to hearing from you soon, and talk to you soon again. Take care. Bye.